Let's get more on the state of the markets and credit and the economy. We are joined by PE giant Carlyle Group co-founder and co-chairman David Rubenstein. It's good to have you back, David. Welcome.
Thank you very much for having me.
Do you think the Fed's done?
I think the Fed is likely to do one more 25 basis point increase before the end of the year. That would be my guess. And I think that's probably the conventional wisdom.
So you're thinking, what, November, December?
It's difficult to predict exactly when, but I think the Fed wants to make it clear that it's not completely happy with where inflation is yet. As you know, its target was 2%. We're not quite there yet. Whether we'll get there or not, we don't know. But I think the Fed is recognizing the market is expecting cuts next year, but the market isn't expecting cuts this year. So I think the Fed can get by with a 25 basis point increase without unduly affecting the markets.
The cuts next year are a hot topic of debate. What, do they come in the first half? Do they come in the second half? What are you guys thinking?
Well, of course, as the Fed chairman always says, everything is dependent on the numbers. And so we'll have to see what the numbers are in the first quarter. But I don't think the Fed is itching to lower interest rates right now. I think they feel inflation's coming down, but I think they were more likely to do something by the second half of next year, not in the first half. That would be my guess.
So given that outlook and the fact that we have seen a stabilization a bit in interest rates, although yields are, the 10 years are around 4.3, is it enough to unlock the capital markets to get activity going? There's been some optimism around green shoots in M&A. We're starting to see IPOs come back, ARMs on Thursday. Do you buy that this is a comeback?
Well, the history of the markets is when interest rates do go down, the markets tend to go up and they're more ebullient. I suspect that will happen now. I don't think the markets are going to be too excited right now. I think they're going to probably wait until there's more clarity, probably early next year, where the Fed's going to act next, what the Fed's going to do next year. But I do think the markets are beginning to show some signs of life, and I do think that you're going to see more M&A and more buyouts in the early part of next year than you've seen this year.
Hey, David, really one last one on the Fed here. Another note this morning. I mean, the question's getting almost a little bit tired, but one does write the rigidness of the 2% target that held for so long is no longer applicable in an era of change in the labor market, supply chain, energy, housing. Do you think the Fed is interested in getting us there? And if so, how would they communicate that?
Well, I think the Fed has taken a 2% target because that's what we had for roughly 25 years before this inflation came about in the last year or so. And I think the Fed would like to get back to 2%, which is considered to be a level where inflation is not a factor in financial markets. But I think getting there is not easy. And I suspect at some point the Fed may say, well, maybe a little bit closer to 3% is okay. In other words, high twos. Getting the 2% is going to be very, very difficult by next year this time even.
And do you think, how do markets react in terms of Fed credibility and dollar strength if that were to happen?
Well, the Fed's credibility is very important to the Fed, and the Fed has been consistent in saying 2%. It perhaps could reinterpret that a bit, but I don't want to be saying I'm sure the Fed is going to change a 2% target. Right now, they're adamant that 2% is their target, but there are many different ways to calculate 2%, I suspect.
David, you see so many different companies and so many different industries within the Carlyle portfolio and beyond. Do you agree that we can achieve a soft landing, one more hike and done, and that they are able to do that, bring down inflation as needed without taking us into a recession?
The history of increasing interest rates, as much as the Fed has done, does not suggest that a soft landing is possible. On the other hand, right now, I do think a soft landing is more likely than a hard landing, and the Fed has done a pretty good job of conditioning the market for what it wants to do. So I think a soft landing is not impossible. I don't think we'll know for another 6 months or so, but I do think that we have a reasonable chance of escaping a recession. The U.S. economy is in pretty good shape relative to the European economy and the Chinese economy. In fact, we're probably much better shape than the Chinese or European economy. So I think the Fed has done a pretty good job. And while people like to criticize the Fed because it's easy to do, I do think the Fed has done a pretty good job under Jay Powell of getting us to a point where inflation is back to where it probably should be, much lower than it was a year or so ago.